subscribe now and press the bell icon. Never miss an update.
Social Security, I was saying, the last thing I said was this is not taxable. Anytime if a client comes and tells you that, okay, I've received some Social Security payments and all, our first answer is going to be that, okay, on the face of it, it is not going to be taxable, but we still need to run our numbers and see if you're crossing certain threshold limits, then it may come up as a taxable amount. And what is that? There's something called provisional income. There's something called base amount, BA, and adjusted base amount. So what they're saying is we have to calculate PI, BA, ABA, and then put in the formula, like if the if PI is less than BA, or if it's like between BA and ABA, or if it exceeds ABA, then it might come up as taxable. So what is provisional income? AGI, who remembers what is AGI now? Anurag? What is AGI? Or Sakshi?
Adjusted gross income. That is gross income less adjustments and deductions. I don't remember the section, but yeah.
Yes.
It comes after gross income minus adjustments and deductions. Okay, section 62.
Nice. How do you remember this now?
Section I didn't remember. Section I have to see in my notes.
Good, but at least you're maintaining good notes. That's really nice. Yes, that's section 62. So we add up all different kind of incomes. We make some adjustments to like most of the time we are reducing that income. So those adjustments or deductions are for reduction of the income, and then we come up to AGI. After that, we apply standard deduction or itemized, and then we come up to taxable income. So the tax is calculated on taxable income, not on AGI. Okay, after doing all these adjustments, then the tax is calculated, and then what happens after that? Honey, do you remember? Once the tax is calculated, like, is that what they're supposed to pay?
And then credits are applied.
Yes, then the credits are applied, which may reduce tax liability. Then we compare it with the withholdings, and we kind of figure out if there's further liability to be paid off or if there's going to be a refund. Okay, so you will see a lot of our calculations are based on AGI. It's not based on taxable income. So that's why I was saying AGI is it's an important concept to know. So what they're saying is, let's take PI, provisional income, as AGI plus tax exempt interest. Any interest which is exempt from tax, and those are usually interest which is given by government, US government or state government on some municipal bonds or some government bonds and all those things. Those interests, we have to, even though it is not taxable, we need to add that, because right now we are not trying to figure out what is taxable income, what is not. We're trying to figure out, do we cross certain threshold in order for Social Security benefits to be considered as taxable in our return? That's what we're trying to do. So we know this is going to be tax exempt, still we need to add it to AGI. Plus excluded foreign income. If you're using form 2555, you're taking exclusion, we need to add that back. Plus 50% of Social Security benefits. Whatever we have got, say that the person is getting $1,000 per month, then we'll take up $6,000. Because for the entire year, 50% is going to be 6,000. Okay, then base amount is going to be, that is something that they have given, IRS has given in their report, that you take 32,000 if it's married filing jointly. And there's now no relief given if you do married filing separately and all those things, and 25,000 for other categories. Then we have to take what is the adjusted base amount. So ABA is the base amount plus 12,000 if married filing jointly, or plus 9,000, which will go for this category, 25,000 and all. Okay, so then let's go through this example. And where is Hemant? Ask him to come here.
Ma'am, I'm here in the call. I
On
joined
the call or in the class?
in the class. Sorry.
Okay. Okay, then Hemant, why don't you only start reading? Na? How do I make sure you are there?
Mr. and Mrs. Sloom both are over 65 and filing jointly and received 20K in social security benefits, and additionally they have reported 30K as a taxable interest and 15K as a tax exempt interest and 18K in a dividend, and taxable pension was 16K. Therefore their AGI was excluding social security benefits of 64, uh, 30K tax liability interest plus 18,000 dividend plus 16,000 as a taxable pension payment.
So why are we taking, wait, let's just stop here. So what they're saying is that AGI excluding benefits is $64,000. What are the, which numbers are they picking up from here? Anyone else? Vinita?
Ma'am, can I say?
Yes, please, Bhavani.
They are not taking 20,000 social security benefits and they are including 30,000 taxable interest, 18,000 dividends, and 16,000 taxable pension. And the
What
tax,
about this thing?
this
Why are they not
15,
taking
15,000 tax acceptance interest.
exempt interest, so they are not.
so what? Okay, so the answer that I was expecting was that they are taking only the taxable part
Yeah.
of the income. Because 30,000 is taxable, it's clearly given, that's why they're taking that. 18,000 is dividend, clearly taxable. Again, they're saying here very clearly that there's a taxable pension, so they're only taking taxable. They're not taking into account the tax exempt interest or social security. Okay, because social security is not taxable, but by doing this exercise, we want to see if it is going to become taxable. So when we are talking about AGI, we just have to take the taxable portion. Okay, so now we are going to calculate PI. So how do we do that? AGI plus tax exempt interest plus all these things plus 50% of benefits. Hemant, read, is that what they're doing here?
PI is 89,000 and 64,000 AGI plus 15,000 as a tax exempt interest and plus 50% of social security benefits of 10K.
Correct. So this is what we are doing, right? Now we are going to add in the AGI, we are adding tax exempt, we are adding tax exempt interest of 15,000. There's no foreign income here, so you can just ignore this part, plus 50% of social security benefits. So we'll take 10,000 now, right? So this is how we take PI to be 89,000. Okay. What is the AB? What is the BA here? What is the base adjustment amount or base amount? Sorry.
32,000.
No, that was a tricky question, Shweta. Who said it? Shweta, was it you?
Yes.
That was a tricky question. I didn't ask what is ABA. I was asking what is BA.
Base amount, right? Base amount is 32 if it is married filing jointly.
Correct. So did you say 32? I thought you said 44.
No, I said 32.
Oh, sorry, my bad. Okay, yeah. So base amount is 32 only. What is ABA then?
Plus 12,000. That is, if ABA is BA, I mean, ABA is BA plus 12,000. So
Correct.
here we are getting 32,000 BA plus 12 is 44.
Okay. So now we came up to ABA amount and all. So what do we need to see is PI less than BA. What is PI? 89,000. Is it less than the base amount? Is it less than base amount? Who can answer that?
Yes, ma'am, it is less than base amount.
Is PI, we have seen here, PI is 89,000, base amount is 32,000. Is PI less than
Oh,
base
sorry,
amount?
no, ma'am. PI is greater than base amount.
Right. So
Base
let's,
amount is less than PI.
correct. So the next thing here, Muskan, I want you to tell me, like, are we meeting this condition? So PI is greater than base amount. But is it less than or equal to ABA?
PI is greater than base amount. Yes, ma'am. PI is greater than base amount and less than adjust and less than PI is greater than base amount and is greater than adjusted base amount also.
So this condition is not satisfied, right?
Yes, ma'am. Yes,
PI
ma'am.
is not less than ABA. So PI is greater than ABA. PI is 89,000, ABA is 44,000. Clearly, we can see PI is greatest of all these three numbers, like the highest number in these three categories. So definitely this 85%, 85% category they'll fall under. What do they say? The benefit inclusion equals social security benefit inclusion, that means we're going to include it in the income, equals to 85% of the total social security benefits. What is 85% of $20,000? Take out your calculator.
$17,000.
So 17,000 is going to be taxable. Let's see what they're doing here. I don't know. They're all doing same thing only, I think. But so in the end, we are coming to 17,000. Maybe this is a very long approach. What they're taking is AGI plus do this, plus do this. So now here they have calculated PI. Okay. Base amount is 32. We saw that. So excess PI, look, so excess of base amount over PI is 57,000. Then excess of PI over ABA. I don't know, maybe you can compare these numbers, but then the calculation is pretty simple here. We need to calculate this and we need to see what category they're falling under. And I mean, after doing all these things, they're coming to the same answer what we got, like 17,000 is going to be taxable. Because they are satisfying this condition that PI amount, PI meaning what? PI meaning we have to take into account all their non-taxable income also. I mean, they can go and they can tell to IRS, well, this is not taxable and all those things. We don't have to pay taxes. IRS is saying, fine, yeah, this is not taxable. You keep it with you, all tax-free. But we know that this is the income that you have earned. So why should you get the benefit of non-taxable social security? I mean, in IRS eyes, these people are making good enough money, so they should pay taxes. So they have good amount of non-taxable income also coming. So that's why they may want to make sure that like people, those who are earning more than whatever their base amount that they have put up as like 32,000 or 44,000. If you're earning more than that, clearly that's the first indication that social security is going to be taxable. Up to what extent it is taxable, that we'll have to do some accurate calculation and we'll have to see what category they'll fall under. But if the base amount is 32,000 and let's say they have no other income, all they're earning is like only 20,000 of social security, they're well below 32,000. So what IRS is saying, fine, don't pay any taxes on any of your social security benefit. Go with 0% inclusion. That means you don't have to report anything as taxable. So when the client asks us, we should be knowing what is the real, rule around it, that they may come and say, hey, I got so much of social security. I know it is not taxable, so don't worry about that. You just work on other numbers. So we need to tell them, yeah, fine, they're not taxable, but we still need to know what you have received and what is your other non-taxable income and all those things, because, we have to calculate this thing and see if some part of it is still coming up as taxable to you. Clear? Divyansh, is that clear? Rohit from Ujjain, Indore, both. Divyansh, what is BA amount?
I'm 32,000.
Okay, good. Maybe Muskan, can you say? ABA. 32 plus 12, right? Correct. Very good. Nice. So this is what we had left yesterday. So I hope everybody is clear now on what could be coming up as taxable for Social Security. Right, so we can move ahead.
Yes, ma'am.
Yes,
Okay.
ma'am.
Let's look into prizes and awards, and also a lot of time again the man IRS, like, I mean, sometimes you may think these are really really small things, why are we even talking about that, but those are the rules that businesses and people have to follow. So small or big, those the numbers don't matter. We have to understand what is taxable, what is not taxable. So even things like what is de minimis fringe benefits. Fringe benefits are the benefits which are given to employee when they are at the workplace, like, simple benefits. It could be like um, it could be like as simple as, here we are talking about prize or awards, and a lot of those, like, companies, big companies and all, they'll probably do some kind of award ceremony or giving prizes, or maybe they're playing games and all, so there might be some raffles and something that will come out of it. And also what IRS is saying, that that should be really like a prize and award only in the true spirit. It should not be used as a tool to give something to employees without paying any taxes on it or without making it taxable. So, what is a reasonable number as per IRS? What they're saying is, if you're giving up to $400, any gift which is given, sometimes companies may give, employers may give some, like, tickets for some concerts, or some travel vouchers, or some, like, uh, discount vouchers or for some things and all. I mean, if there is a real value, if they can go out and if you can sell it for something, that means there is a value to that. So what they are saying, that up to $400, that's not a problem. So if you see in the profit and loss account, if you're looking into a company's profit and loss account and they say, oh, $5,000 given as awards. If you see that in any of the companies, we should be asking, what is the breakdown of that $5,000? If there's one person who has got $5,000 or two people got $5,000, clearly there is a problem. You should report that as a taxable compensation in W-2. But if there are more than 10 people, or maybe like 13, 14, whatever people, so it does not go above $400 per person, then we are fine. Okay, we cannot just take the company may take say that no, it's fine, we gave some $1,000 to somebody, 1,500 to someone and all. So that's okay, they can pay as much as they want to, but then make sure the company is also paying taxes on that in the form of social security, employer taxes, and the employee is also paying taxes, because it will not come up as a tax-free item. This is for non-qualified plan. So whenever they use the word plan in US scenario, that means there is something in writing. There is a plan, there is a document in writing which says what is what are the rules that company is supposed to follow if they are giving out awards, what are the conditions that need to be fulfilled, and and everything else like around that. So there has to be a document in writing whenever we say plan. If there is not a proper formal document and all, that means it's not a qualified thing and all. So there they have put a less limit. If you make something formalized and say, okay, we have a qualified plan award, meaning that there is no discrimination between top employees or middle level or lower level, the policy is same for everybody, and it's going to be consistent through all the offices of the company, all those things. Obviously, like if the office is in one office is in US, other office is in India, they have to take cost of living difference and all, and accordingly do that. Okay, otherwise, I mean, they have to see whatever the local laws are. So those are called qualified plan. If they have fulfilled all the conditions of putting up a qualified plan in place, and that's usually done by HR or legal and all, then they can even pay up to $1,600 per employee without making it as a taxable award. So we need to just remember these kind of things when we see award and prizes given, and if you see that as an expense item, we should be definitely asking that give us the breakdown, who all have received, give us something that we can check it back with. So obviously, if the employer exceeds the limitation, whatever limitation that they have given, if you are going to exceed it, then it becomes taxable to the employee. So the employee has to include this in his or her gross income and all. Okay. And if the employee is including, employee is including that as gross income, so employer can take that as an expense as well. Okay, we'll just go over this example. It will make it clear. But what is a qualified plan? It's an award. It's an employee achievement award provided under an established written program. There has to be a proper program. Program meaning not like programming Aniket. Don't think that. But there has to be a proper legal written document that does not discriminate and all those things. So there are certain legal conditions that need to be fulfilled, and then we can call it as a qualified plan. Okay, Sakshi, can you start? Or maybe Rohit there, like one of you.
Assuming that an award costs the employer $500 rather than $400 and its fair market value is $475. In this case, the employer's deduction is limited to $400 and the amount includable by the employee in his or her income is $100. That is the greater of difference between the item's cost and deduction limitation, $100, or the amount by which the item fair value market value exceeds the deduction limit, $75. If the fair market value was $600, the amount includable in the employee's income would be $200. The remaining portion of the fair market value of the award is $375. $475 minus $100 is not includable in the employee's gross income.
Okay, Sakshi, can you explain?
Yes, ma'am. The cost to the employer was $500, and the amount that is exempt is $400. So the difference is $100. This 100 will be includable in the income of employee. Okay,
Okay.
first we have to compare the actual award $500 with $400 limitation, and then we have to compare it with fair market value. So the difference of 500 and 400 is 100, and the difference of 475 fair market value is 75. So the excess value, the greater one, $100, that will be includable in the
Correct.
employee's
It's
income.
a simple concept is IRS does not want to lose in their revenues. Whatever is the greater amount, that they'll say, fine, you just add up the higher of these two. Either you compare it with fair market value, compare it with the cost.
Cost. Yeah. So if fair market value is 600, so the amount will be 200. Obviously, that's 200 is excess. So 200 will be includable in income.
Right. Okay. All right, let's go. So unemployment benefits, yesterday we already spoke about 1099G is issued. So you guys need to remember that. Then or put it in your notes and all. Whenever you see a 1099G, it is issued towards unemployment benefits. So think about it, like it should come to your mind that why is this person getting a 1099G? Maybe this person lost his job for a few months in the particular year. So in that case, the commonsensical thing that comes to our mind is that maybe there should be two W2s, because if he lost the job and then took up another job, we should expect two W2s. Right? So these are all the things that we should remember, and we need to ask the client. Like, we should not say that, oh, just because the client did not give us missing W2, we filed on it, and so it's none of our fault if we are not filing right returns. Wrong returns. If we are filing, it's not our fault. We cannot just give that excuse. If we see a 1099G, it should come to our mind that he was unemployed for some time. Is it possible that he'll take job with the same employer? Very, very unlikely. Usually they'll go and get job in some other company or some other employer. So there should be two W2s. Right? Or the amount, if you see suddenly very big amount on a W2, that should also come to our mind. Like, okay, until last year he was making, say, $10,000 a month, so 120,000. Suddenly this became 170,000, 180,000. Why? Again, that could be part of severance package. There's a lot of, right now we will see I mean, maybe next year we'll see this. A lot of people are getting severance package as the layoffs are happening in US. We'll see big amount, credited to them or given to them, but because they're getting paid for next 2 or 3 months, as the layoffs are happening, that's like, I mean, we read this news every day. So severance package will be provided by every company. So then again, that should be very reasonable when we are comparing things. It should be like coming to our mind that, okay, that could be the reason. That's why they're having higher income and all those things. Try to link everything together. Don't just look into one document and say, okay, 1099G given to me, I've put that in the tax return, my job is done. We have to understand what is it about, what is it linked to, does it make sense? If we put all the pieces together, does it make sense or not? Okay, compensation for injury or sickness. So any compensation which is given for any damages or for personal physical injury or physical sickness is usually, it is not taxable. Okay, they are specifically excluded from gross income, which is very fair because as it is, the person is going through some injury or sickness and all. So, I mean, IRS is fair in saying that will not be taxable. There could be workers' compensation. Workers' compensation is, again, it's a kind of mandatory insurance. If a client is, again, write down these points, you'll not remember. But if you're writing them down, you'll probably remember when this kind of situation comes. If a client is coming and asking us that, can you set up my payroll in US? I need to hire 1 or 2 people. What do? We'll say, okay, yeah, provide us these documents, and we'll do that. We'll just do all our calculation of taxes and all. We'll see this is the net amount. You pay employee this much, you pay IRS this much taxes, you pay to state so and so, and we're done. Is that right? No. There's something called workers' compensation. This is a mandatory requirement. The payroll people will not come and tell you that, okay, workers' compensation is there or not. If you don't have workers' compensation, will not run the payroll. Like, for example, if you're going with paychecks or Intuit and all. But it's part of our responsibility. We should know that if you're running a payroll, if you're hiring a person in US, workers' compensation insurance has to be there. What does that mean? That any worker, meaning worker in the sense any employee, if they get injured while they're on job, okay, if they get injured, like there could be some accident, or simple thing is there could be some water on the floor and they slip, and they may hurt themselves and all. So the employer has to compulsorily carry that workers' compensation insurance, so the insurance company can reimburse the employee. It's not like employer would not reimburse. It's not the question of whether employer would want to reimburse or not. It depends. If they want, they can reimburse. If they don't want, whatever, it's between employer and employee. But as far as the law is considered, they're supposed to have this insurance. So every time we are setting up a payroll, please make sure whether it's there or not. If it's not there, it doesn't cost much. It's like $200, $300 for full year. But at least that paper, that document, we need to take that, okay, this company has taken this insurance. Under, any accident and health insurance policy, if they're getting reimbursed and all, so yeah, they may get the benefits which are a substitute for lost income. So if the income was not lost, it was a taxable income, right? If the person is, say, temporarily disabled, and the person cannot do any work for next 2 or 3 months, just sitting at home, and through this accident and health insurance policy, if they're getting some fixed payments every month, that as long as you're not on job, this insurance company will pay something. So in a regular scenario, the person would have made money and would have paid taxes on it. Here also, the person is making money through insurance policy, but they don't have to pay any taxes because this is due to a genuine reason. Any reimbursement that the employer gives for whatever medical care and all those things, it is not considered to be an income. Okay, and any pension, annuity, or similar allowance kind of for any personal injuries and all not considered to be income. These are the amounts which are excluded. Again, damages received for personal physical injury or physical sickness. 1 minute, let me just read this. The followings are excluded from gross income regardless of whether the damages are received by lawsuits or agreement or okay. So it doesn't matter whether they are suing some company and they're getting it as part of the lawsuit or as part of some agreement or out of court settlement or as lump sum or as installment payment, whatever. Doesn't matter. But if there is a personal physical injury, if we can, the employee cannot just come and say, oh, I got some, I'm very much like I'm very anguished or I've got some emotional disturbance going on and all, so I need that. No, it has to be a physical injury certified by a doctor saying that okay, this person has really injured himself or herself. Payment, yeah. So here, payment received for emotional distress if an injury has its origin in a physical injury. Because of the physical injury, if the person is getting into emotional distress, yeah, that could be covered. So those kind of compensation, they have to be included in gross income. And I mean, IRS is saying that is something you have to pay settlement. I mean, you have to pay the tax. Any in or out of court settlement for lost profits in a business. I mean, if the person got injured and they say, well, I'm not able to run business for next 6 months, so I'm losing so much of money because obviously like the business is going down and all. So that also compensation can be given by court, but that is all part of income. Punitive damages received are included in gross income, even if they're connection with a physical injury and all those things. So wrongful death damages can be excluded to the extent they were received on account of uh, okay, what they're saying, I mean, again, we're coming to personal injury or sickness if it's there, and even if they have received any wrongful death damages and all, they can be excluded to the extent that they were received on account of personal injury. Maybe there is no death, but there is an injury. So to that extent, it can be excluded from income. Remaining amount has to be included as taxable income. Any damages received only for emotional distress, they are included in gross income. Because see, there is no dollar amount that you can put on emotional distress. People may file suit for like $100,000 or whatever, $10 million. We don't know what thing triggers emotional distress to what person. That's a very subjective thing. If the person breaks the arm, it's very much there on the paper. Yes, the bone is broken, the arm is like it's going to take 3 months to fix it. He's not able to do the regular day-to-day job duties, and so that's why there is a compensation which is given. That can be verified, that is given by doctors and all. But when you talk about emotional, mental agony and distress and all those things, it's kind of, there is a subjectivity. That could be real, it could be just made up thing, or it differs from person to person. We don't know. So you can, I mean, what IRS is saying is like, if there is something only related to emotional distress, put that up as income, pay your taxes on it, and that's fine, take that money. Any interest earned on an award, obviously, any interest earned part will always be as a taxable, even though award itself is not a taxable income. But if there is a delay from insurance company or from employer and they say, fine, there is a delay of 6 months, but we'll pay you a reasonable interest. Interest will come up as taxable amount. Okay. In general, we need to remember if there is a physical injury and all this insurance money which is given, or any medical reimbursements or compensation, all in general, they are not considered to be taxable income. Any medical deductions and all, like, I mean, you can read this thing. Who can read it? Tanya, can you read this? It's just some kind of example here.
Recovery of medical deductions. If the taxpayer incurred medical expenses in year one, deducted these expenses on his or her year one tax return, and received reimbursement for the same medical expenses in year 2, the reimbursement is included in gross income on year 2 return to the extent of previous deduction that was allowed on the return.
Yeah, so simple terms, please explain. Simple words में explain करिए.
Whatever deduction he applied for in year 1 is taxable in year 2.
What is the situation here? If they've incurred medical expenses in year 1,
yes,
and received in year
and
2,
received reimbursement in year 2, the reimbursement is included as is included as a part of gross income in year 2.
right? Because he's already deducting those expenses in year 1. What they're telling the IRS that, okay, I have incurred these expenses, you give me a deduction of those. But in year 2, maybe the employer comes and says, well, yeah, you have paid so much for your medical thing, we'll pay you back. Then it's not like they should get benefit from both the places. One place is IRS is already giving a deduction, you're not paying taxes on it. Then on the second hand, like on the other side, we are also getting reimbursement from the employer, and again not reporting that as an income. So that's not fair. Okay, so that's what IRS is saying, that if you are claiming deduction, then that compensation should be taxable income. Otherwise, you pay it out of your pocket, you get compensation, and it's fine. Like, don't claim any deduction, because actually it's not going from your pocket. So why are you claiming deduction? It's going from the pocket of the person who is reimbursing it. Right? So that should be considered as a taxable. It's same thing like expense reimbursement. If employee says that, well, I've spent $5,000 on so and so thing and all, and they got compensation of $5,000. Okay, and next, like maybe after the year has changed and all, the employee figures out, well, it's actually not, it's not 5,000, it's only 4,000, and or maybe it's less than that. Then that extra amount has to be considered as an income, because they are receiving a deduction as well as receiving a compensation. Okay, any accident and health plans, any benefit received by an employee under accident or health plan, under any accident and health plan and all, they're all excluded from gross income. Even if a lot of times the employer will take those plans and all, the premiums are paid by employer. So again, what are the conditions? Obviously, there has to be some permanent injury and all those things. That's why the benefit is given. Or there has to be some reimbursement and all. And those are the conditions. If they're all satisfied, then you don't have to take that as an income. And again, the plan is something which is being set up by an employer. So the plan should not discriminate. They should not design in a way that obviously the top management people have more control. So they'll say, okay, if, the top people will get $100,000 compensation. And the same injury, if it happens to somebody else in the same kind of circumstances, they get only $10,000. There should not be a discrimination. Okay, so that all needs to be, anytime they're writing a plan, there should not be any discrimination. Whatever plan it is, it's a retirement plan, there's health benefit plan, or the employee awards and reimbursement policy and all. It should be same for everybody. Excess, obviously excess reimbursement and all. Excess reimbursement over the actual cost of medical expenses may be excluded only to the extent the taxpayer, okay, if taxpayer is also contributing to the plan, a lot of times they have a plan saying that, okay, 50% of the premium will be paid by employer, 50% of the premium is paid by employee, or in some other ratio. So if taxpayer is also contributing, then they get a deduction for whatever amount they're contributing. Okay. Disability policy, again, they're all tax free. And what they're saying is here, if they are sharing, again, disability is kind of insurance policy and all. So if the employer pays 75% of insurance premium, employer, okay, an employee pays only 25%. Wait a minute, disability. Okay, no, so there is a difference now here. Okay, so disability policy, I'm sorry, that's clearly saying that proceeds from disability insurance policies are tax-free only if paid by the employee. Employee has to pay the premium and all, then they get tax-free. If the premium is shared by employer and employee, then in that ratio, we'll have to figure out what is taxable, what is non-taxable. So we have to prorate into taxable and non-taxable amount. Okay, there is you can just take the disability insurance policies, and that's why a lot of we see that in the net pay and all, we are taking a deduction for the disability insurance also, SDI, that is state disability insurance. You'll see a SDI deduction, SUI deduction and all. Okay, then employer provided dependent care. A lot of times there is a daycare that employee will set up on the campus that, okay, the children can be, can be on the same campus with the employer provided daycare and all, or maybe the employer will give up to $5,000 of dependent care. So you will see this amount. A lot of times we see this amount in W2. In the other box and all, it will be mentioned. I don't remember under which code. So if that is the case, we have to give a proof at the time of filing return that this amount was actually used for the daycare purpose. And if the facility is provided by employer himself, then any amount that is all excluded completely. Only up to $5,000 of per year. And if employer is just providing $5,000 as cash, that you go and we're giving you $5,000 extra so that you can put the child in the daycare, then that will come up as taxable unless we provide the proof that that $5,000 was actually spent out for the purpose of daycare or after school and all. So school is not included because school is something like a basic thing. Every child has to go to school, but not every child will be going to a daycare, which is like after a school thing. Or if the children are too small, like they're toddlers or infant and all, they don't even need to go to school, then they'll have to be put up in the daycare. Okay, so the whole point is that because both the parents are working, they'll have to use daycare. Otherwise, there's no need and all. Or if both of them are like full-time students. What form do we use for the dependent care benefits? DCB. It will come up in 1040, it will come up as DCB. Tanya or Shweta, you guys should remember. What is that form number? Because this is a common thing. We see this $5,000 of dependent care benefits.
That's schedule 2441, that one.
Form 2441. Okay. So employer provided life insurance. Generally, proceeds of a life insurance policy, we have seen that they are excluded from employees' gross income. Certain premiums paid by the employer are, however, included. If something happens, there's a life insurance, the person dies, they receive the money, that is generally not taxable. But if the employer is paying for life insurance, it's like employer is giving a kind of benefit. So only certain premiums can be put up as taxable for employees. What is the condition? That if you're paying anything for more than $50,000 of coverage, that could come up as a benefit, as a fringe benefit to employee, and that could be taxable. So these kind of things, like employee will probably not care much about it. Like they don't know much rule and all. Whatever employer gives, they'll probably take the W2. But employer, when they're setting up their payroll, when they're hiring employees, when they're providing all these facilities, they should be knowing, how to consider what amount as taxable, what not taxable, what are the limits, so that they can provide the best possible non-taxable benefits to the employee. Structure, design it in a way. So when we are doing the setup, payroll setup for our clients, those who are employers, if we know about all these rules, we can be we in a good position to tell them that get this kind of policy, do not make it go above 50,000. So all these benefits an employees will get, which will not be considered as taxable for them. An employer is anyways getting a deduction for all that cost, so they are not losing on anything. Any long-term care coverage are non-taxable employee benefits and all. Okay, pension. So pension, what they're saying is pensions are most often paid in the form of annuity. Does anyone remember what is annuity? Rohit, do you remember? Any of the Rohits? Or Anurag? Do you remember what is annuity? Siddhabi, do you remember? You there?
Anything you earn on top of a basic cost.
Right. So we talked about it. There is some kind of investment that a person makes, and then they get the returns, annual returns, fixed amount for certain period of time, or monthly returns, whatever. So they take the form of annuity. And we saw that in annuity, how are they taxable? That whatever amount the person is putting up as an investment, that becomes the cost of the annuity. So when the person is getting the same amount back, obviously it should not come up as taxable to him or her. It's like if I have given $10,000 to somebody, they're paying me like $15,000 back. Would entire $15,000 be taxable again to me? No, it's not making any sense, because $10,000 which I have given, which I've put money into annuity, that itself is a post-tax money. I've already paid taxes on it. Now, all I'm doing is I'm just getting my principal back along with the income. So income part, we understand that $5,000 will be taxable, but that $10,000 should not be, because that is our cost basis. So pensions also take the form of annuity. And because the employees are contributing to it, it's not completely like, I don't know how it works in India and all, but it's not completely like same kind of structure. When we talk about Indian pension system or US pension, they're kind of different. So employees are able to recover their cost tax free. So there's certain, like over a period of their salary, there's certain amount every month they'll be putting in pension and all. And then if they get, like, if they're retired or if they are disabled, even before they reach retirement age and all, they'll get it back. So amount withdrawn early, they're treated as recovery of employee contribution. Employee contribution is excluded from gross income, because it was not tax deferred earlier. They have already paid taxes on it. So why would they want to, like, why would IRS want them to pay taxes again? 401k is different. When they put money into 401k, they're getting a break on tax. So when they take it out, they have to pay taxes. Is that understandable to all? Okay, both of them are post-retirement benefits kind of thing, but they're all taxed differently. But any pension which is received from a foreign employer and all, they don't get all of those benefits. Everything will be considered as taxable. And I mean, they may be fully or partly taxable. We have to understand what are the rules if it's coming from a foreign pension, because on that money, they probably, I mean, US has never received any tax. It's a foreign company paying paying pension to now a US resident. Maybe earlier they were not. So we'll have to see. It could be fully or partly taxable. Okay, then any of the death benefits, all death benefits received by the beneficiary on behalf of an employer are included in gross income. Okay, so death benefits, do not confuse that with death benefits of a life insurance plan. If a life insurance gives something, we know it is not taxable. But if there are death benefits, let's say the employee was working and died, and the employer are giving certain benefits um, to the family of the deceased employee, those should be considered as taxable. We're not talking about, they're clearly saying do not confuse it with the benefits of a life insurance plan. Rental value of personage and all, ministers. So here when they say ministers, they don't mean like political ministers and politicians and all. They mean to say that these are the clergymen or the priest in the temple, or like the fathers and all who are running the churches, all those people, they are called ministers because they're working for a religious organization. So what they're saying is, they lot of times they're provided rental facility. Maybe they stay in the temple only, the priest or the clergy person will stay in the church facility only. So what they're saying is, this not to be taken, like all that rental facility given should not be taken that as a taxable income to them. They don't have to pay taxes on that. Usually, if there's an employee working for a general, like a for-profit company and all, and if the employee has been given like a long-term, residence and all, that will be considered as a benefit. I mean, if it's a short term, if you're visiting for like a month or 2 or 15 days, just to go and visit one of the office and come back, and there, if the company is providing something to stay, that's not a taxable perquisite. Okay, so what they're saying is that, like, if we see that if you're doing a tax return of these priests and all, and then we'll have to see that, okay, rent, like they can live for free, they're getting all the rental benefits, but they don't have to pay taxes on that. They have to pay, it's subject to self-employment taxes, but not the income tax. And what is self-employment and all that we can see later. But we just want to, right now, the whole idea is that you should be knowing if the person is working for the church, what kind of benefits they're given, or if there are any military officers and all, and if they are like placed in some border area or in the war zone and all, and if they're hospitalized or combat zone, and if they're hospitalized as a result of wounds, disease, injury, which is very common for a military person, they may not be able to work for next few months or whatever, and they may still get the salary, right, for that period, because the government has to give. So those, in order to make it more fair to them, they're saying that um, it will not be considered as the taxable income. So we have to, only if they get like injuries and all as a result of the war, or as a result of some kind of like the stress, if not even declared war and all, maybe there's some other attacks or something, like what they're saying, that it's a danger zone in which they are in and all. So they don't have to pay taxes on that. Okay, we'll just finish up this part. Gift or inheritance, obviously it is not it is not included in the gross income. Gift is something, there's a different kind of tax, gift tax, inheritance tax are applied. So it is not included as part of income tax. There's a whole different law on that. What is state tax? What is gift tax? When is it applicable? But what they're trying to say is, do not include that income in the gross income of the recipient and all, if the property is acquired by gift or inheritance. Treasure trove, if somebody just finds something, they're just maybe taking a walk on the beach and they find a diamond ring worth, say, $10,000. What IRS is saying that, like, yeah, you have to pay taxes on that, even if you find something and all, if they come to know. And if it is indisputably in the possession, like nobody is going to come and claim it, no one is able to put up their right to get it back. So taxpayer I mean, the person who found it, they get to keep it. Then what IRS is saying, well, fine, you're lucky you found that, but then you pay our taxes. Any gambling winnings, gambling is legal in US. One can go and gamble, and there are a lot of casinos and all. So any gambling winnings, they are taxable. Gambling losses can be offset against gambling winnings. No other expenses, nothing else can be offset. You cannot say, well, I took a flight to Las Vegas, I spent $10,000, I stayed in the best hotel, and I hired a chauffeur or whatever, but I did only to get gambling income. So I should be able to deduct all those expenses. No, that's not the case. You can get, and there is a, what it is called, Tanya, is it W2G or something? There is a document that is given for gambling winnings. It's called either W2G, I can't remember, but that the moment you see the document, you need to understand that, okay, this is from the
It's
winnings.
mentioned here, W2G.
Oh, sorry, I didn't even see that. Yeah, I was just, okay. Any recovery of tax benefit item, that anything that, like the clear example, what they're writing here is bad debts. If your books are on accrual basis, you took a deduction for bad debts. After a year or two, you really got lucky, and the company comes and says, hey, we got some money, we want to pay you back. Well, then we need to make sure that it is put up for tax purpose. Again, considered as an income because a deduction was taken earlier. Okay, so we'll just stop here. Let's just go over these couple. This is, we'll just finish up this part also. This is very small. Reimbursement for moving expenses. Okay, so until year 2000, I don't know, 17 or 18, there used to be a deduction for moving expenses when people are changing jobs and moving from one city to another, or forget about one city also, even if they're moving like 20 miles away from one place to the other place, then because of the change in the job, then moving expenses were deductible. In fact, when we moved from US to India, we took all that moving expense deductions and all, and a lot of clients took it around that time, but now they have stopped it. There is no such benefit given as moving expenses deduction, not to the general taxpayer. That's only given to military members. Okay, so let's just start going over these examples. And did I miss something here? No, I think we have covered all the examples. This one we have done, right? Okay, next, Vanna, 2.13.
Yes. Taxpayer pays $2,000 state income tax and itemizes deductions. Subsequent refunds must be included. However, if taxpayer used the standard deduction, the refund would not be included because no tax benefit from payment of state income tax was realized.
Right, so if there's something that they have already taken a deduction for, we need to make sure that it is put up as a taxable income. But if there's no deduction taken, then there's no income to be reported. Okay. Any other questions? Otherwise, we'll stop here and we'll continue tomorrow on from this point, adoption, assistance, and all.